Fractional reserve banking. Our video on the economy's information-carrying particle established material obligations as the pheromones that control productive operations of human civilizations. Money's operational significance was then proclaimed to be the abstract unit of measure used to calibrate material obligations. A little illustration of vendor financing was then offered as an account of how money is created in parallel to the accepting of an obligation, and of how money is annihilated when the obligation is fulfilled. Here we wish to extend the notion of vendor financing to banking, which is to say, the more general operations through which money is created in parallel to the origination of financial obligations. Once again, we will proceed in the way of an allegorical tale to better highlight the most revelatory aspects of our subject. It has been a long time since much of anything happened in the steady states of equilibria, the good old SS of E. Then a certain citizen, entrepreneurial by name, had the idea for an economically useful device that he duly patented. He would need a factory to produce this device, but, the steady states being at the time optimal, there was no way to enforce the temporary diversion of the population's energies toward the expenditures with which to build a factory for production of Entrepreneurial's new gizmo. So Entrepreneurial sought out the banker ex nihilo, who agreed that the former's invention would indeed ease the burden of labor in certain sectors of the SS of E, thereby increasing the general welfare. Ex nihilo created an asset for himself in the form of an offsetting entry to a deposit into Entrepreneurial's checking account. As the new factory was taking form, Entrepreneurial's balance declined, while balances increased for those who had worked on the factory or supplied materials for its construction. Entrepreneurial's spending of the money created for him necessarily bid up prices for the goods and services required to create his factory. As is necessarily the case, the new money spent into circulation caused an inflationary transient in the SS of E. This was something of a hardship to the population at large. Higher prices forced the average citizen to scale back his consumption of goods and services, so as to effectively make these goods and services available to build Entrepreneurial's factory. Higher prices had temporarily forced a diversion of existing assets from immediate consumption toward creation of a new physical asset, on the expectation that this asset would be a net benefit to the SS of E. Now it came to pass that the factory was completed. The money created by ex nihilo for Entrepreneurial's use had passed into the accounts of those who had built his factory, and these accounts constituted new, enforceable claims against ex nihilo's assets. Fortunately for all, the factory was a success. Its profits not only provided Entrepreneurial with a passive income, there was enough left over to service his debt to ex nihilo. Since the asset ex nihilo had created for himself was earning an income, it could be sold as an annuity, if such were ever necessary to honor the claims of those who had supplied labor and materials that went into constructing Entrepreneurial's factory. These financial successes only reflected counterparts in the enhanced corporal realities into which the SS of E had settled. Entrepreneurial's new device ultimately meant that the SS of E's general population could now consume somewhat more than they had before, while expending somewhat less effort, even while providing a new flow of profits to Entrepreneurial. The SS of E, having retained its composition as a uniformly civil and industrious people throughout the disruptive period, saw their good fortune given the widest distribution through action of their free markets. Eventually all concluded that their transition had been worth the period of stress thrust upon them by creating new money for first use by the proprietor of a new enterprise. Entrepreneurial then proved to be an unusually prudent man who wished his success to pass on to his posterity unencumbered. He therefore contented himself with less passive income from his profits in order to pay ex nihilo more than he owed in interest on his original loan, thereby gradually reducing his principal obligation to zero. This had no effect on the new, improved physical stasis of the SS of E. But redemption of his earlier debt annihilated the money that had originally been created, to the end of deflating SS of E's currency, less money being needed simply because none now flowed from entrepreneurial to ex nihilo. Our tale is completed by drawing out 3 morals. 1. Creating money ex nihilo is like counterfeiting, in that it gives advantage to whomever is granted first use of the money. 2. Diluting the value of money in the pockets of a population does indeed harm them in the present moment, and can only be justified if advantage is specifically granted so as to achieve a general betterment of future circumstances. 3. An economy at its optimal equilibrium is analogous to a person standing fully erect, in that neither can jump to a higher level. Both must gather their energies into a crouch in order to attain something higher. The practice of fractional reserve banking has been given many alleged, as well as verifiable, derisive characterizations. One of the most cited originated with Henry Ford. It is well enough that the people of the nation do not understand our banking and monetary system, for if they did, I would believe there would be a revolution before tomorrow morning. There is no denying Ford's authority in these matters. In fact, his career could not be a more perfect instantiation of the benign and optimistic tale just told. The basis for Ford's derision almost certainly lies in his direct experience with the actual bankers who financed his great success, and the personal mobility provided through his initiative. It is easy to develop an antipathy toward those who must be appeased in order to carry out one's ambitions. What purpose is served by awarding a cash flow to someone who contributes nothing tangible to the creation of the entrepreneurial's facilities or his products? While this is an answerable question, the answer will not suffice for all who ask it. First of all, fractional reserve banking requires a reserve to assure solvency if loans are not repaid. Gathering the reserves necessary to acquire a bank charter is not a trivial undertaking. One must seek out investors and convince them that investing in one's bank stands to be profitable. This is typically accomplished by committing one's own funds to the reserves. These reserves are at risk because they are committed to making depositors whole when loans cannot be recovered. The banker is legally and morally obligated to exercise good judgment in hypothesizing future value. If his judgment is not consistently good, he and his principals will be bankrupted and/or find themselves in legal peril. Fractional reserve banking generates societal costs and risks in exchange for what are hoped to be the societal benefits of economic growth that would not otherwise occur, or, rather, not be realized nearly as quickly. In sum, the creation of fiat money acts as a lubricant that eases transitions from complacent economic states to yield higher optima as these become technically available. Our tale illustrates the wise and beneficial use of fiat money. In no way does it assure that such wisdom and beneficent intent will always attend the transactions described. Fiat money is a tool having no moral component. It can be used for good as well as for evil, depending on the intent of those entrusted with its use.